Since you clicked on this video, like me at one point, you probably felt overwhelmed with words like appreciation, depreciation, accounts receivable, accounts payable, just to name a few. And it all might seem like it was made on purpose to confuse people, but once I learned the basics, it was like an epiphany. Everything seemed clearer to me. And in this video, I'll be teaching you the basics and the fundamentals of accounting and finances so that you feel confident in any financial discussion or decision that you need to make. At the end of the video, I'll also be sharing some tips that have helped me grow my businesses for the past 20 years. But first, I want to share a story with you. So this is me in my second company. We're growing, I think this is like year 3 or 4. And as you can see, I was wearing glasses and I still had hair, both of which are gone now. So we were about 3 years into the business and we started doing something unusual for us, which was we started working with post-pay. Previously, all my businesses and everything else was working with prepay, so it was very simple. I get paid first and then I deliver any services that I wanted, right? At the time, we were sending leads to vacation home landlords, and they were paying us 10% commission of whatever money they made. And there was no payment up front. So all their customers were paying them upon arrival, and they would pay us as well. So 1 month in, quite early in this format, I was expecting a payment to come in from our largest customer. And as any good entrepreneur, I was always living in my bank account, so I knew exactly which money was coming in and out. And then once I got my report, my profit and loss statement from my accountant, and I saw the amount that was in there, I got cold shivers down my spine because I was like, that's problematic if I miss that, because we have payroll coming up and we're tight on cash, right? So I quickly double checked our bank account, that payment hadn't come in. And that's when I had a discussion with my accountant saying, hey, what's happening here? And that's when she explained to me what the difference is between cash-based accounting and accrual-based accounting. So cash-based accounting is what we learn intuitively as kids. You probably had the same experience that you got some pocket money as a child and then you could spend that, and whatever you had in your wallet or in your piggy bank was what you could spend. So very simple learnings here, right? It's one-dimensional. And if you don't have money in your pocket, then you don't have money to spend, which means that transactions are very, very, very short, right? But they all make sense. Like it's super simple. A child can understand this, right? And you don't need a financial degree. So why are we all overwhelmed? Why are we overwhelmed by finances and all of these fancy words? Because the world doesn't live in cash-based accounting systems. We live in accrual-based accounting systems, and they don't teach this stuff at school. Very simple. And here's the official definition of accrual accounting. It says, revenue is recognized when goods or services are delivered and the earnings process is complete. If you understand that sentence, then the second part will make absolutely sense. While expenses are recorded when they are incurred, regardless of whether payment has been made or received. Why did I say if you understand the first sentence, then the second one will make sense? Because if you think about it logically, any invoice is doing two things at the same time. If I'm issuing an invoice, that is income for me, revenue for me, and at the same time, it's an expense for somebody else, right? So by default, if revenue is counted at the point of delivery, once you've delivered goods and services, that is exactly when you get an invoice. So somebody has to receive that invoice, right? So that's how expenses are made. If you're like me and that still doesn't make complete sense, I'll make it much simpler for you, okay? All entries into your books, into your ledger, so this is where they put all the incoming invoices and the outgoing invoices. So for a specific month, everything is put in there based on the dates of when those documents were issued. So all your incoming, all your expenses that came in, that invoices with the dates in that specific month are put in that month. And also all the invoices that you gave out with the date of that month are put in that same month. And that's what you're comparing. You're comparing basically documentation. It has nothing to do with the flow of cash. Please keep that in mind. So just to summarize, cash-based accounting is based on the flow of money. So when actually money is exchanging hands, right? So it's you either paying from your piggy bank or you get some money coming in, right? That is cash-based accounting. Accrual-based accounting is based on documents and how documents are done, okay? So basically, it's a question of timing. One is based on timing of the cash flow. That's why it's called flow, cash flow, how it's flowing, and the dates of the invoices. And that is what accrual accounting is, okay? So you might ask the question, why is the world living on accrual-based accounting and not cash-based accounting? So a short history lesson / kind of background story for all of this. So imagine, as us as a society and civilization were moving along, everybody started out with cash-based type of accounting, and everything was based on, cash exchanging hands or anything that was exchanging hands, gold, silver, so on and so forth, right? So people were kind of living on, whatever you have in the vault, in the bank, or in your card, or in your pocket, basically, was what you had. And if you don't have it, then you don't have anything to spend. And that's a very simple system, very one-dimensional system, very basic type of system. As people started accumulating more and more and more, they started seeing some downsides towards that, which are the people that accumulated the most. What did they have to do? Right, they had to pay money for somebody to guard that vault or guard that chest or whatever it may be, right? So you had, maybe you had to build a castle if you were super wealthy. You had to pay mercenaries to keep a guard and keep guards on them. So you had to feed these people. There was a whole infrastructure around that, and there was a cost associated with just keeping the stuff that you had earned from somewhere else, right? Not very sexy for anybody. So the story goes that sometime in the Renaissance, some people say it was the Medici family or something like that, came up with an ingenious way of saying, okay, how about we stop wasting funds on securing our wealth, and why don't we give it out to other people? And that's how we started having all kinds of financial instruments, starting with basic loans, going to all kinds of other types of instruments. However, if you think about it, how can you trust anybody based on cash-based accounting? It's super easy to manipulate the books. Any owner can just not pay expenses, those expenses are not there, or the other opposite is they can go to their friends and family and just give them, pockets of money, some gold here, and just virtually kind of ask them to make payments in, and it looks like your business is doing really, really good on paper. So people needed to look and evaluate businesses on a specific period or a specific time. So they thought up of a way to actually include that, and the only way that you can do that is if you log all of the transactions, regardless of if money has been paid or not. Basically, what we're doing here is we're mapping out what the obligations of the business are, right? So we get 4 key elements once you do accrual accounting. The first is you're matching revenues and expenses on the same reporting period, so you can assess the operational performance, right? Which is to say, normally, if you look at a business for 12 months, the 12 months that you're looking at are the same. The formula behind it is the same for every single business. It doesn't matter what business you're in. The formula and how everything is calculated is the same, so everybody has one way of looking at it. The second thing that you get out of accrual accounting is an understanding of accounts receivable. So this is how much money is still supposed to come in, right? And accounts payable, which is how much money is still supposed to go out. And these are both early warning signs for potential cash gaps. The third thing is it allows you to prepare a balance sheet that reflects all the resources and the obligations, not just those already settled in cash. So what that means is that on the balance sheet, you will have the full picture regardless of how much money needs to still be exchanged. The last thing is you can compare the numbers with cash flow statements, spotting any profit cash kind of gaps that could signal other hidden risks. Namely, the main one is late payers or non-payers. So you can look at, what percentage of people are actually not paying you, where you've got agreements and you've issued maybe invoices, and you can value that risk specifically, okay? So that is the reason why everybody's living in accrual accounting, and that is the main lesson that you guys should learn from this. Now, with accrual accounting, there are 4 key terms that you need to know, which are important. So the first one is accounts receivable. We kind of already touched upon that. So what this actually means is how much money customers still owe you to pay. So this is basically pure profit, money that you're expecting in, but you've delivered goods, you've done everything for it. So this is just pure cash, right? From an obligations perspective, this is an obligation on suppliers to pay you, right? So this is an obligation for somebody else that you'll receive. This is one of the best things that you can see in accounts receivable. The higher this is, the better. Then accounts payable, the total opposite. So this is money that you still owe to suppliers, and the obligation in this case is on you to pay in the future. So you've committed, you've already received something, and you have to pay for that. So naturally you'll understand, if your accounts payable is larger than your accounts receivable, that's a problem, because you're expecting less money to come in than money that's going to go out. Oh! Then you have accrued expenses. So these are expenses where you've already paid, so the costs have been incurred, but you haven't yet received an invoice. So the obligation in this case is on the supplier to issue an invoice sometime in the future, probably next month. And the fourth one is deferred revenue. So deferred revenue is cash received but not yet earned, which means that somebody has already paid you the money, but you still need to do the work. And regarding obligations, it's an obligation on you to deliver your goods or services, right? Why are these 4 terms important? Because these are the 4 key terms that anybody from the outside world will assess your business or your financial health with. Okay, these are the 4 basic things that people look at, from bankers, insurers, investors, to accountants and partners and all this kind of stuff. These are the terms that everybody will use, and if you use them, you'll be part of the gang. And I have just 2 general rules that I would like to share with you guys. The first one is, and we already touched upon this, if your business has higher accounts receivable than accounts payable, it looks healthy to everybody. And that's the first thing that anybody would do. If you give them that document, they'll look at okay, how much have we got in receivables and how much have we got in payables? If receivables is more than payables, great. So the less you have in deferred revenue, the better it is for your business, because that means that you have more capacity, right? So just think about it. If you have a lot of deferred revenue, which means that you've sold already a lot of your capacity and you haven't managed to deliver that means that if you're a service, your people's time has already been booked into the future. And that means that your capacity to put more work on those same people is less. Similarly with goods, if you haven't already delivered the goods, that means that you're stretched in terms of how many goods you can still deliver. The deferred revenue means this is the amount of your capacity that's still available. So with your existing team, with your existing setup and everything that you have, how many more customers or how much more revenue could you get with the existing team? This is what deferred revenue kind of indicates. Kind of to circle back onto my second business and what that meant for us. Until then, all of my businesses had been working on prepay forms, so everything was super clean. Basically, my profit and loss was basically the same as cash-based accounting, because it was based on everything that was coming in. I was getting money and coming in first. But so I didn't fully comprehend the implications of moving to post-pay until I had actually done it. And there are 3 main points that I want to share with you guys that are important if you move to post-pay. So the first one is, if you move from prepay to post-pay, you're stretching out the transaction, and especially the first transaction. Instead of getting money and then giving the product, you have the 30 days that they're using the product, plus they have the 30 days that they have to make the payment for the service. So that first transaction goes from money in or no service to you're providing the service and then getting money, your first money, in 60 days. Now, once that is set up, obviously it's every 30 days, but that does mean that the first transaction goes from you not getting anything paid to you getting paid in 60 days, in the best case scenario. And why do I say best case? Because that leads to problem number 2, which is with postpay, you will be chasing payments. Nobody pays their bills on time. I'm sure you've also had situations where you've forgotten to pay a bill and there was no menace behind it. It just slipped your mind. Life happens, whatever, right? So just keep that in mind, that their situation you will have more processes in place to keep an eye on actually getting the money then from your customers. It's normal when you're on postpay. And last, but by far not least, is, and this is something that a lot of people miss, or they don't talk about, or they just forget about it, which is, you pay tax, because everybody's on accrual accounting, you're paying tax on the invoices that you issue, right? So for us, that meant, for example, that I was living in Ukraine at the time, and Ukraine has value-added tax. So this is extra tax on top of your services. So let's say if my services cost me 100 euros, then I needed to put on top 20%, right? So the bill for the customer is 120 euros. Now, the government still wants those 20 euros from me, irrelevant of if the customer has paid me or not. So if the customer hasn't paid me and the time has come for that tax payment, guess what? You're going to pay it out of pocket. So it's a kind of, you can have a double whammy there, in a sense that the person hasn't paid and you need to pay taxes, which is extra costs on top of that. So once I knew all of these nuances, and I knew that I'll have to be paying tax on top of invoices and these kind of things, like irrelevant of people have paid me or not, we implemented basically 3 strategies that helped us out. So the first one was, we didn't provide postpay to everybody. We only gave it to select customers, and for other customers we introduced a retainer system. So they were paying us up front for something, and then we were basically topping up that budget and using whatever, we were just deducting based on how much they had on their balance, right? The other thing that we set up for the post-pay customers is we decreased the number of days that they have to settle invoices. So the standard for invoices was 30 days. We cut it down to 15 days. Most cases, actually, you can feel free to cut it down to even 7 days. There's no reason why they need 30 days to make payments. These are, this is a historical thing that has been dragging on for way too long. And to be honest, for most of us, if you're providing a service, you can try to do things where, like, you give access to the service, but you issue the invoice on the same date as you give access, and they just have 30 days to pay. So think about it this way: instead of giving the service for 30 days for free and then issuing the invoice, give the service, issue the invoice at the same time, just with 30-day payment terms. So they have time to pay your invoice at the end of those 30 days, and it kind of keeps aligned, and it's more or less within the same month that you're looking at. Tip number 2 and strategy number 2, what we implemented was talk to your accountant actually about taxes and which taxes have which obligations. So my accountant, because they decided that it's just easier for them, what they were doing is they were looking at the total at the end of the month. They calculated how much taxes need to be paid, and they were just paying that tax up front. Now, that's all nice for them and it's clean for them, but in the scenario that but it's not mandatory. And in the scenario that you have an invoice that you've issued and it's to a customer who hasn't paid you and is never going to pay you, you have a time frame during which you can cancel that invoice, and you're not going to be penalized for it. So in Ukraine, for example, that was once a quarter. So so let's say we're in Q1 now, right? It's January, February, March. So I could keep all the invoices that I had from January and February and not pay that tax, and keep those invoices kind of hidden, so to speak, from the tax authorities. And then based on the results in March, so who has paid me from my January and my February cohort, the ones that haven't and it looks like they won't, I can cancel those two, I can cancel the invoices. Which means that at least, yes, I've provided them a service and I'm not going to get money for that. That's a whammy, but at least I'm not taking the double whammy, in the sense that I've also got to pay tax on money that I didn't receive, right? So just keep that in mind, talk to your accountant and have place in some strategies in terms of like when do you pay big chunks of taxes and how that's moving around and how documentation is moving around. Now that you know accrual accounting, you understand that documentation and timing of documentation is the main thing. So yeah, and the third strategy that we implemented that helped us was actually to put in very strong penalties. So not these, couple of percent or 5 to 6, 7%, whatever, annual interest rates for late payment on days and blah, blah, blah bullshit, but actual real penalties. Meaning, for us, it wasn't only about getting the money, but then it was also about our trust. So if you had stepped over that barrier and we don't trust you anymore, you are going down the pecking order. So again, because we were selling leads, let's say we had a customer come in and they could buy a certain amount of leads and a certain amount of, a minimum amount of leads, for example. If they didn't pay us on time, we would then penalize them in the sense that they can come back into the system, but they're not going to get the same level. So if, for example, last month they got 100 leads and they made X amount of money through our system, and they didn't pay us on time, the next time they can come into the system and they would get up to 50% less. And it was for an extended period. It was like for 6 months, you have to now show us that you're going to pay every single invoice on time, every single time. And then maybe we can bump you up, right? So they have something physical they have something really tangible to lose. And if you have that, then you have more leverage and ways to force them to pay you on time. So thanks for watching. I hope you like this type of content and it was useful for you and you feel more confident and less anxious about finances. However, this is just scratching the surface and I'm sure you have multiple questions still, or you have now more questions than when you started out. Curiosity is a good thing. The other thing is that with accrual accounting, this gives up new possibilities and opportunities for you as a business owner. So in the future, I'll be going over very specific things that accrual accounting opens up and how you can use that for the benefit of your business or your personal finances, for that matter. See you in the next one. Cheers.